Welcome to Life Planning 101, brought to you by Kennedy Financial Services in Eastland, Texas. Tune in every week as we share important information to help you and your family live life on purpose. Insurance, investments, legacy and tax planning, and much more. All covered now on Life Planning 101.
Good morning. We're here on Black and White Market Chatter on Life Planning 101. Matt Ervin and Aaron Kennedy here to talk to you about some things that are going on and really with all the chaos, why to keep the long-term focus of investing. Now, Aaron, we got many current events going on, Ukraine and Russia, inflation, COVID, oil and gas prices,
Oh my gosh. Good morning, everybody. Yeah, I think we even put out an article, Angela did, 100 Reasons Not to Invest. And actually, it was a reproduction, wasn't it, of several years ago.
Right. It still applies.
It always applies. There's always a reason not to invest. But a lot of this stuff is hitting home right now to a lot of people. Go fill up your car. You're going to feel it, and that's very personal. Go to the grocery store. Now you're wondering, how am I going to feed my kids? It's very, very personal. We get the attack from the media constantly telling us how bad things are and putting us against one another politically, which is just, there's so much going on right now, and it feels like there's no hope.
Yeah, and that challenges a lot of the short-term emotion. And one of the things we talk about a lot is removing that emotion from investing, sticking to long-term principles of investing and fads. We started this by talking about some of the fads that have happened, FANG stocks, but even going back to the days of the 60s, the Nifty 50.
Yes.
Talk about some of that.
Yeah, the Nifty 50, it's pretty neat historical lesson. Going back 1960s, markets were really excited about 50 great companies like McDonald's and Coca-Cola, IBM, these great quality companies, and they had nice growth rates, and they were these companies that you couldn't fail if you invested in. So they went a little over a decade, and everybody bought them, and they got super, super expensive. So you look at companies like McDonald's that were trading at a little bit over 70 times earnings. That's crazy. Right. 70 times earnings for a hamburger, Some of them make sense, IBM, I think Kodak, some of these newer technologies that the economy was creating. But on top of that, people got away from fundamentals of paying a good price or a fair price, and they were willing to pay whatever it was in the market because they couldn't fail.
Right. So really, it was this momentum. We talk about factor investing a lot.
Yes.
Get down to the basics, right? And why things are doing, why things are behaving in a certain way. And that was just the momentum, because those characteristics of those prices is just, it does not align with good fundamental investing.
Right.
Because really, long-term investing is based on fundamentals. You look at it, so not that they were bad companies, right? Quality companies, good cash flows. It's just what price were we paying for them?
That's exactly right. Fundamentals are you want a great company that has some form of a moat that can continue to grow, and then keep the shareholder in mind with their decisions. That's quality. And then on top of that, you need to pay a fair price. Because if it's doubling every 7 years and you pay twice the price for it, there's no return. If you pay 3 times the price, you're going to lose money.
Yeah. Even on good companies, right? Our goal,
on great companies.
The goal is to have measurable progress in a reasonable amount of time.
Yes, sir. Absolutely.
Right? So, and that could mean different things for different companies. They're not all made up the same. Some have huge cash flows and dividends. Others are, more growth-centric, where they don't pay out dividends, but they have different ways to improve their worth and value as it drills down to your balance sheet. Right?
Yes.
So it's just important to focus on, what's driving that. Where do we want to be? We talk a lot about, Frank's plan. We've mentioned that several times, and Frank's plan is it's interesting because it first starts out, says, this is easy. Frank from work just said, put everything in technology. That sounds great, doesn't it? But usually, if it's put everything in technology, it may already be a little bit saturated.
Yeah, That's probably not a contrarian bet. If we want to get all that concentrated, because, that is a true momentum effect, and that is human behavior at its finest. It's been working; it'll always work. Jump in with me,
right? Right, and then so it grows, and that we start to see a kind of a retraction in pricing. And it says, Frank said, this is normal. I should double down. And so what do we do out of kind of our recency bias, right?
Right.
That's one of the things that drives us is we pay a higher weight to what happened more recently.
Yeah.
And so we say, okay, we're going to hang on that. Let's double down. And we may be in a kind of a more contraction stage of the market cycle.
We call it a little different this year, or not this year, these times. I think it's called FOMO.
There you go.
Fear of missing out.
Yeah.
Very technical investing term.
Right. Yeah. That's right. Yeah, that's good. Well, and so then once we talked about Frank's plan, market, he doubled down, it pulls back, and then you start to get a little anger. We have an illustration that we've showed several clients at our office, and basically this is the red face that says, I hate Frank, right?
Yeah.
He's frustrated at his friend because he listened to him, he doubled down in a kind of a retraction part of the market. And then we get to the bottom and says, I'm never doing this again.
Yes. Never doing it again, and then it takes right back off, and we do it again, over and over.
And then the last part of that is Frank said this time's different.
Yeah.
And I think that's one of the points we're trying to drive right now is it's rarely different. On the surface it appears that way, but there's always a reason to not invest, and there's always a reason to invest. Right.
It's kind of funny. It's one of the things my ears really pick up on. If I hear this time is different, I'm like, it's time to go running away from that right now.
That's right. Well, let's take this opportunity to take a quick break right here on Black and White Market Chatter on Life Planning 101. And we're back here on Life Planning 101, Black and White Market Chatter, picking up. We were just talking about Frank and Frank's plan. And so we want to dive into some of the, there's always a reason to invest, and there's always a reason to not invest. And we're creatures of emotion. You were saying that the cavemen, right?
Yeah. It's kept us alive for millennia. We used to huddle together in caves. We'd light fires, and that was to keep us safe. If you look where the early humans, where they lived, it was a place where they could gather food, where the animals were, and they did all this out of safety. And then you look at it even a little closer. There are some greed factors there, because they would empty all the berry bushes, and almost wipe everything out until they moved on. Right. So we're constantly in this pull and push of fear and greed, and it's nothing new. Our survival instincts are something that has kept us alive, kept us alive. So if we can kind of understand that, we can use that to our advantage and make better decisions rather than making decisions on our recency bias of what's happening right now to keep us alive.
Well, and we talked about the Nifty 50 just a few minutes ago, and that greed, right? This will never go away. This will never change. If you hear that from someone, you might just turn around and walk away, because never is a hard frame to reference, right?
Yes.
We have things that happen more often or not more often, but then we get into when we look at some of these investor biases, it's important that we keep things in check, and then look at the opposite as well. And we have the gambler's fallacy, right? That it says if you flip heads 5 in a row, you're more likely to flip tails. Well, not necessarily, because every time you flip your coin, it's 50-50.
It's always 50-50.
Right.
If you flip it 100 times in a row and heads, there's still a 50-50 chance of what's going to happen next.
That's right. So, anyways, it's important to identify these, because that's our job too, is to help people identify them, understand them, so we don't fall prey to them.
That's exactly right.
We're not in the days where we, if we don't hunt today, we'll have zero food tomorrow. We can make educated decisions. We can make decisions on what price we enter things. So the Nifty 50, for example, great companies at the time, right? The fundamentals were solid.
Yeah. But still great quality companies.
Right. But there's a point for which you're paying too much for a good thing.
Yes.
Would you pay $15 for a gallon of milk? Probably not. You're going to wait till it comes down to that $4 range again. You're going to buy your milk as normal. So
Right.
milk, the quality of the milk is still great.
Yeah.
But is it worth 15? Probably not.
That's a great way to put it right there. That's exactly right.
Yeah, so that's good. So another thing, we talk about biases a lot because we can oftentimes fall prey to them. And one of the things that we do is the confirmation bias. So this is easy to understand because a lot of times we'll find information that helps prove ourselves to be right.
Yeah.
We're greedy as humans. That's our nature, to be greedy. We want to be correct. So we go find the 3 articles, online that say, yeah, this is right. We go to our friends and say, hey, look. Aaron and I do this a lot, and we try to, pick opposites.
Yes.
If Aaron brings something, I say, well, let me tear it apart, and same back and forth. So it's fun, and
right.
So the falsification bias is like the opposite of that,
right.
where you're trying to prove yourself false. So but either way, whether I'm right or wrong, if I always think I'm right or I always think I'm wrong, I'm falling prey to a bias, and that's what we have to keep in check.
That's exactly right. Once you kind of figure out what these biases are, and it's part of my DNA, I've got to find a way where I can break out of that. Because if not, I'm just like everybody else, and we're falling to the swings of up and down in the markets and everything else. So even like Matt was saying, when we have our discussions, we encourage poke holes. What can go wrong, and it's helpful.
Yeah.
It's very, very helpful.
Yeah, because we fall prey to that caveman mentality,
Yes.
right? We want to be survivors, but as we've adapted as humans, we've realized it's not this or this. Sometimes you can have a middle ground, right?
Yes.
So we want to keep that in our frame of mind when we're talking about investing, when we're talking about when to enter the market, when to exit the market, and we're actually excited because although volatility doesn't feel comfortable, it really feels uncomfortable for a lot of people. It presents buying opportunity, right?
Yes.
Because those ticks in the market, there are buys and sells. And a lot of times, like we talked about earlier, it's driven by short-term momentum and can be a lot of emotion.
Absolutely. That's all the short term is. Can you imagine trying to guess what Hershey's is going to sell tomorrow?
No.
No. What about how much money Microsoft's going to bring in tomorrow?
Right.
And even if you stretch it out to a month or a quarter, it's a guess. It's all just a guess. So you really got to focus longer term, because if not, you're falling into that momentum, and momentum's a great factor that works, but it's designed on price, and there's a big difference in what a company is selling for and the quality of that company or how that company is performing, and that's where as humans we really deviate in our investment world.
That's right. We're reading an article, and it was referenced something like just 3% of returns are explained by fundamentals in the short term, such as a 1-year time frame.
Right.
Okay.
3%. Man, Vegas would jump all over that.
Yeah, and it really takes, when we look at these fundamentals, we're talking long-term investing, 10, 20, 30 plus years of why things work in our cycles. And we've referenced Frank's plan before. And so there's certain times in the cycle to be in certain kinds of things. And that's what makes this so exciting.
Yes, absolutely. The toughest thing to do is invest through volatility. So you really have to be prepared mentally for this to happen.
Right.
And you got to flip everything on its head to do it.
You bet. So let's take a quick break right here to wrap up before we wrap up our last section of Black and White Market Chatter on Life Planning 101. And we're back with the final segment of Black and White Market Chatter on Life Planning 101. Aaron, let's talk a little bit about, we've talked, I guess, thus far about some of the reasons that people don't invest, some of the reasons they invest blindly, confirmation bias, falsification bias, so some of those fundamentals of investing. But let's talk a little bit about what we're doing. We believe, based on those fundamentals, that we're going to have some volatility continued, right? It's been more volatile than it has been for some years, and so let's take advantage of that.
Absolutely. That's where we are, and I am really excited about what's going on right now. Really excited. I think this is going to create some opportunities that's going to set a lot of people up for life. And how did we get to this point? We had to flood the market with a lot of money during COVID. There's a certain part of the market that got insanely expensive. I mean, just like the Nifty 50, they were great quality companies that are producing a lot of cash. A lot of them are producing great earnings, but they're ridiculously priced right now. So would I be excited to buy some of these companies at half off or, 2/3 off? Man, absolutely. I'm definitely not willing to pay those prices today, those elevated prices, but I think they're going to come down. So we're positioned for that. We're definitely not giving up on the market. We're in different parts of the market that are relatively cheap, that are paying us a great dividend, kind of pay us to wait. We know where we are in the cycle for what's going on today. So we're investing there, but we're also, trying to get that greed factor going. So we're putting some stuff on the sidelines
The
to
dry
just
powder.
wait. Yeah, we got some dry powder, and we're ready to jump on it. And that's exciting.
Yep.
That's really exciting.
Yeah, one of the things, I want to tie in some of the things we're talking about. So what we're talking about here is being ready for when the market has kind of a recessionary period. Do we know how big that's going to be? No. Do we know how long it's going to last? No, we don't, right? We're not trying to crystal ball this thing, but what we know is based on the fundamentals that it will happen. And the higher the market goes, it's more likely to happen.
Right.
Now, it still could be a year or 2 years down the road, right? We're not, that's the point about not sitting on the sidelines in cash.
Right.
Because then we
can't give up.
Yeah. We talked just a few minutes ago about, the short-term prediction, right? 3% of stock returns are explained by fundamentals in the short term, right? So that means the up and down volatility, the ticks of the day, you can't tell me what the next tick of the tape is going to be, up or down.
No.
So we're not trying to time that. It's not smart to do so. But what it is understanding that when you kind of, maximize your view and look at where we're at in the cycle, how quickly information moves, right? So, think about 08, through that recessionary period versus what happened in March of 2020.
Yeah, the speed was just immediate. And I think that's what caught most people off guard is the speed at which the government actually reacted. Most time you think of gridlock and them not being able to do anything, but not this time. We went to bed and we woke up with trillions of dollars. It was just basically overnight, and it caught a lot of people off guard. But this time is not different. We're still having the same effects. Economics still has its part in this. It just takes a little bit of time to work through it. That's the timing part is something that very, very few people get right. And if they do, it's only one time.
That's right. It doesn't happen often. But the thing is, we want to be ready.
We have to be ready.
Because we know things are getting the price and earnings that you're paying, the price that you're paying for those earnings is getting mismatched.
Yes.
We know when that happens, it's going to create buying opportunities. So we're being prepared to take advantage of those buying opportunities.
Absolutely.
Right? So we're keeping it super simple. We always hear investing is as simple as black and white. Right? We want to keep it very basic, very simple, stick to the fundamentals, not fall subject or prey to these biases or fallacies.
The more complicated something is, the harder it is to stick to it.
Right.
And it's simple. Keep your fundamentals in line and always focus on the long term.
Right. Long-term fundamentals work 97% of the time.
Yes.
That means that luck factor is 3% in long term.
Yeah, I'd rather have 3% luck than Well, this is going to sound weird. If I'm investing money,
Long term.
right? I don't want to rely 97% on luck.
No, and that's the thing. You can, it's like driving down the interstate. If you're exceeding the speed limit, it's hard to react. And when something happens, it happens much more quickly. If you're going the speed limit, being a prudent investor, a disciplined investor, you can react, and you may have to kick off the cruise once in a while and slow down, but the long run, you're going to get where you're going with something that you're pleased about.
Yes, get where you're going safely without any tickets.
That's right. Measurable progress in a reasonable time.
That's exactly right.
That's fair. So when all the chaos happens, why do we want to keep investing for the long term? Because we know that works.
We know that works. The greatest companies are going to be around in the future as long as they're doing the right thing, keeping the shareholder in mind, keeping their balance sheet clean, all these great things that we know can make a company successful. And the opposite, not so much.
Right.
We can see them bankrupt if you take on too much debt. So, just little things like that. Let's keep our fundamentals at the top of mind, and let's go help you live life on purpose.
That's right.
Not next month on purpose.
That's right. That's right. And if y'all have any questions, we encourage you to call us and talk specifically about your situation or specifics about what we're doing. Always encourage that. We're here for you, here to serve. And so, Aaron, do you have any departing words for our audience here on Black and White Market Chatter?
We're all in this crazy time together. We're here for you to help you get through these times. And if it takes something as looking at it as something as an opportunity, give us a call. We're here for you.
So this is Matt Ervin and Aaron Kennedy on Black and White Market Chatter on Life Planning 101.
Thank you for joining us for Life Planning 101, brought to you by Kennedy Financial Services. If you have questions, you can email them to lifeplanning@kennedy-financial.com. Don't forget to learn how our sister company can assist you with all of your tax, bookkeeping, and consulting needs. You can find out more at briscoeandassociates.com. Be sure to tune in next week for more Life Planning 101. The opinions expressed herein are those of the firm and are subject to change without notice. The opinions referenced are as of the date of publication and are subject to change due to changes in the market or economic conditions and may not necessarily come to pass. Any opinions, projections, or forward-looking statements expressed herein are solely those of the author, may differ from the views or opinions expressed by other areas of the firm, and are only for general informational purposes as of the date indicated. Securities offered through Calton and Associates Incorporated, a registered investment advisor, member FINRA SIPC. Investment advisory services offered through Smart Money Group LLC. Kennedy Financial Services and Smart Money Group LLC are separate entities and are not owned or controlled by Calton and Associates Incorporated.